Hello and welcome. You're watching Business Today TV. I'm Sakshi Batra. Well, how much tax do you pay on your stock market investments? If you're somebody who started to invest in stock markets in the last 2 years, in the boom of the equity markets, then you must know that the profits that you earn on your investments in stocks, either directly or mutual funds or various other routes, then you are liable to pay some form of tax. In this video, I will help you explain all of those things so that you are aware of what form of tax and how much tax you are liable to pay in case you're earning profits on your stock market investments. So the tax rules really differ from and vary from the equity instruments that you are invested in. For example, if you invest directly and purchase stocks directly via demat accounts, or you have an exposure to stocks via mutual funds, or thirdly, you have ULIPs or the unit linked insurance plans that have exposure to equities, all of these forms of equity instruments attract some form of the tax that you are liable to pay on the profits that you earn on equity investments. Now, given that different equity assets have different tax rules, an investor must definitely take a careful look at the suitability of the investment in terms of taxation as well. So, taxes on your equity investments reduce overall returns, and therefore, it is absolutely important for you check which form of the equity instrument you're liable to pay how much tax on those. So let's look at the various taxes that are applicable on your equity investments. So four categories broadly that you are liable to pay tax under in case you have exposure to equity as an asset class. The first one is the long-term capital gains tax, or the LTCG. The second one is the short-term capital gains tax, or the STCG. The third one is the intraday trading, which is considered as the speculative business income, and that also attracts some tax. And the fourth one is the dividend income that is also taxable as well. So let's start with each of them to help you understand what tax and how much tax do you pay under these broad categories and why and where are these applicable as well. Let's start off with the LTCG first, or the long-term capital gains tax. Any profit from equity investments is considered as long-term capital gain if your holding period is more than 1 year. Now, LTCG up to 1 lakh rupees from equity investments in a given financial year is actually exempt from tax. So any profits that you make that are accumulated in a financial year up to 1 lakh rupees beyond 1 year time frame is exempt from tax. Any gain above 1 lakh rupees is taxed at 10%. This you add the education and health cess, and totally you pay 10.4%. Whereas the short-term capital gain is applicable on any profit if your holding period is equal to or less than 1 year. The STCG is taxed at a flat rate of 15%. But including the health and education cess, it comes up to be 15.6%. The next is tax on intraday trading, which is seen as speculative business income. As per Income Tax Section 43(5), profits earned on trading in equity or stocks for intraday are categorized under speculative business income. The gain on this type of income is added to your income and is taxed as per your tax slab. The fourth form of tax that you may have to incur on your equity investments is dividend taxation. From financial year 2021, all dividends in the hands of investors are taxable as per slab rates. In other words, dividend income will be added to your income and will be taxed as per your income tax slab. Now, while people investing in direct stocks or via mutual funds have to pay dividend tax, it is not really applicable for those investing in ULIPs or the unit linked insurance plans. Now, this was about tax and profits of your investments. But what if you actually make losses on equity investments? Then what happens? Well, as per the income tax rules, any loss under the head of capital gain can be set off with income in capital gain. So a long-term capital gain loss can be set off against long-term capital gain. Short-term capital loss is allowed to be set off against both LTCG and the short-term capital gain. Now, there is also a provision carry forward your losses if you're unable to set off your entire loss in a given financial year. Both short-term and long-term capital losses can actually be carried forward for 8 assessment years. And that entirely gives you a picture of how much tax are you really paying on your equity investments. 4 broad categories: 10%, 15%, the dividend tax, the intraday tax. And apart from that, you also should know which instrument are you investing in. The direct stocks, which are the listed stocks, equity exposure via mutual funds, and thirdly, via ULIPs. All three of them have these different categories. All of them give you, in fact, attracts the LTCG and STCG based on the holding period, 10.4% on a long-term basis, and in the short term, a flat rate of 15%. With the education and cess, it becomes 15.6%. Dividend taxation applicable for direct stocks and for mutual funds, and not applicable for ULIPs as well. And any losses can actually be offset against the profits that you earn from capital gains or investments in equities. So I hope this video was useful to you. Such videos, if you really like and like to watch and understand, then definitely leave a comment. Do like this video as well. And don't forget to subscribe to our Business Today TV channel.
If you like the video, do like, comment, share and subscribe.